Hello everyone, I'm here with you with another topic. Today we are going to discuss what is volatility and liquidity in Forex and what is the relationship between two of them and how they affect each other. So let's dive into it. Okay, what is volatility? Volatility is the price movement or fluctuations or variations or anything you can name it of a trading asset. It determines and measures the difference between the opening and closing price of an asset over a specific period of time. For example, a trading currency pair that fluctuates between 10 to 20 pips is less volatile as compared to a currency pair that fluctuates between 50 to 150 pips. Okay, fair enough. So we can determine that if the asset is high volatile, then there is a high risk, and if there is low volatility, then there is low risk in trading the asset. So what is the relationship between market liquidity and volatility? So let's see what is liquidity. So liquidity measures the availability of an asset or how quickly you can buy or sell it from the market. Okay. For example, if you want to buy euros or gold or silver in any amount, then you have to see whether it is available in the market or no. Is there any seller who is actually selling that amount so that on the other hand you can buy that amount. Okay, and in highly liquid instruments you can easily buy the required quantity. Okay, for example, euro and USD pair trade, you can trade up to 10 million or more during the London market session because there is more liquidity in that London market session. And number four, and timing is also very important if you want to analyze the liquidity of any trading asset. So why timing is important? So let's take an example. For example, if you want to execute Euro USD trade at a time period between the close of the US trading session and just before the opening of the Tokyo session, then you might end up with the low liquidity of this pair and your trade can suffer a lot. So timing is very important to determine the liquidity of the particular asset. Number six. So in a nutshell, we can conclude that the more liquid a trading instrument is, the lower the volatility, as it will take much more to move the instrument in a specific direction. So conclusively, we can say that emerging market currencies such as Mexican peso or South African rand or even Indian rupee are easier to move as they are more volatile because of their less liquidity. Okay, now what is the relationship between market liquidity and volatility? So let's see what is volatility again. The range of price movement, volatility, uncertainty, fluctuations, or whatever you name it, they are all the parts of the trading market. And we have to have a price movement so that we can take a trade. So volatility is must. But at the same time, no volatility does not mean that there is no price movement. There is still price movement. And as a trader, you need to understand all the dynamics of volatility, and the situation becomes challenging for traders when volatility becomes too high, because then you cannot guess which way the markets are going. And as a trader, you need to understand which currencies are more volatile. Okay, now factors influencing market volatility of currency pairs. So what are these factors? Number one, monetary policies. As a trader, you know what is monetary policy. It's a very common factor. Managing the flow of money by the central banks by using tools such as interest rates. These are called monetary policies. And forex traders must keep an eye on all the top trading currencies, uh, central bank policies. For example, US Federal Reserves, England Central Bank, Bank of European Central Bank, Bank of England, Bank of Japan, Bank of Canada, and Reserve Bank of Australia. Number two, trade wars. How trade wars affect market volatility of a currency pair. Trade wars between countries can also impact currency volatility, and you can see visible impact of trade wars between US China, US Russia, or even US Europe. Geographical factors. Third factor, regional conflicts such as military invasions, uprising, riots, and other forms of civil unrest can count as one of the major causes of volatility. and a prolonged situation of high level of uncertainty is not good for market volatility. And number 4 and last one, market sentiment. And around the world, traders and investors, they make sure where the market is moving and what is the prevailing sentiment driven by people, and that sentiment driven by people can create a risk on or a risk off trading environment. So these are all the factors that affect your liquidity and volatility in forex market. So I will conclude here. I hope you like the video. I will see you next time. Have a good day. Bye bye.